This is a textbook candlestick chart showing a perfect order block setup. The zones are drawn and the trend is clear, but instead of bouncing, the price suddenly crashes through your support line, triggering every stop loss. Retail traders spend months memorizing the terminology of inner circle trading and smart money concepts. They study the jargon with a singular belief that they have finally identified the exact footprints of the world's largest banks. The failure begins when traders treat these high-speed institutional mechanics as static lines on a chart. Markets are reactive environments, a strategy that relies on drawing fixed shapes without accounting for real-time order flow is destined to fail. Adopting the vocabulary of the inner circle offers no protection. Without understanding the intent behind the move, a retail trader often becomes the very liquidity they are trying to hunt. In the current market, predictability is a liability. When a massive group of traders reacts to the same signal, they create a concentrated target for entities with enough capital to move the needle. Profitability in trading requires an imbalance. Someone must be wrong for someone else to be right. When a strategy attracts millions of views and creates a consensus among the retail crowd, the resulting concentration of orders makes that edge vanish. Institutional algorithms are designed to find where these orders cluster. By tracking highly publicized retail strategies, these systems can locate precisely where the most stop losses are buried in the market. These strategies do not provide a secret path to institutional success. Instead, they give the world's largest funds a clear map of exactly where retail liquidity is most vulnerable. These mechanics trace back to the analog era of the early 20th century. Long before digital charts, Richard Wyckoff codified the phases of institutional accumulation and distribution that form the basis of modern smart money theory. A side-by-side comparison reveals the rebranding. A modern change of character is the exact same price structure taught as a trend reversal for decades. The pattern holds for order blocks, which align perfectly with traditional supply and demand zones. Rebranding these concepts creates a false sense of security. It leads retail traders to believe they are witnessing something exclusive, rather than the same public price action everyone else sees. Changing the name of a pattern does not change the underlying auction. If an algorithm is programmed to exploit a specific retail behavior, it will do so regardless of what the trader calls it. Institutional trading is a game of scale. When a fund needs to move billions of dollars, they cannot simply hit a buy button. They need a massive volume of sell orders to fill their position without driving the price against themselves. Institutions use inducement to find that volume. They push the price into a retail order block to encourage crowd buying. Then they drive the price below the zone, hitting tight stop losses and triggering a massive wave of automatic selling. This cascade of forced selling creates the liquidity the institution needs. They can now buy millions of shares from panicked retail traders at the exact price they want. The retail trader sees a chart as a fixed arrangement of lines. The institution sees that same chart as a map of human behavior and order flow, looking for the most efficient way to fill their books. A setup that feels like an unlucky failure to the individual is actually a perfectly executed liquidity grab for the institutional desk. Staying profitable over time requires mechanical discipline and meticulous risk management. Theoretical knowledge of the market means little if it isn't backed by the ability to execute under pressure. Proprietary firms frequently see candidates with high-level market knowledge fail their evaluations. The issue is rarely the theory. It is a complete lack of emotional control during live execution. This leads to SMC fatigue, where traders jump from one concept to the next after a few losses. They blame the strategy's validity rather than addressing their own impulsive overtrading. Even the most sophisticated structural analysis is worthless without a systematic approach to trade management. A hybrid solution treats these concepts as a directional filter rather than an absolute truth. It uses the logic of institutional footprints to determine a bias, not to guarantee a specific outcome. Successful traders use time-based filters, like kill zones, to focus on periods of high institutional activity. This limits their exposure to the low-volume noise, where retail traps are most common. Protecting capital requires aggressive risk parameters. In a market designed to hunt liquidity, a stop loss must be treated as a calculated cost of doing business, not a personal failure. To succeed, you have to move past the debates over terminology.